Okay. We'll begin with Avia Spivak, who is part and parcel of our program, of our Klal program. Chaya, Avia, Lilach, and I work together on this workshop and on the whole program. Avia is the Pauli Vanir Managerial Economics Professor at Ben-Gurion University in the Negev. He was chair of the department. He was the dean of the faculty in Ben-Gurion in Social Sciences and Humanities. Right? Yeah. Here are two different faculties. He's a senior fellow at Van Leer in Jerusalem. And he served as the deputy governor of the Bank of Israel. So, I guess he knows what he talks about when he talks about pensions. So now you'll explain the system to us? Is that the idea?
In 20 minutes, yes.
Yeah, we'll give you 25 because you were with the organizing committee. Yeah, please.
Okay, so I will try to be as precise and as short as possible because I have a lot to cover. So the framework is how do we evaluate the success of pension reform, and the first thing that we have to realize, we talked about it, is that the total privatization, and it follows an international movement, starting with averting the old age crisis of the World Bank that I saw that I think Angela was quoting. And there's the famous case of Chile, who went from DB to DC in the first pillar, which is really amazing. And we heard yesterday over dinner that Eastern European countries who followed the Chilean example retraced their steps, and they're moving back to the old pay-as-you-go system. Okay, and even, I don't have time to leave it for the end, even in Chile itself, they reversed what they did, which is very nice. I mean, they were the leaders, the so-called example, and it failed. If I'll have time, I'll explain why it failed. Now, the criteria to evaluate reforms, as you see, is the fairness, efficiency, and includes sustainability, which is very important. Non-economists try to think that things will get somehow together themselves, but they don't, so we have to take care of the sustainability. And the inequality and poverty among the elderly. And as I write here, I remind you of the famous Beveridge report from 1942, which said that we could eradicate poverty among the elderly. And so this was the prime motive for having a Social Security. Okay. Now, privatization had many ways. One way was the NDC in Sweden, Italy, and other places. I don't have time to explain it because I have to talk about Israel. And the transition from DB to DC that Angela talked about yesterday, which is very famous. And what happened in Israel? Okay, so the first wave was in 1995, and what was done? Okay, let me explain the three parts of the system, if you want. We had one part which was which belonged from the beginning to the insurance companies, some kind of life insurance with eventually a sum that you get at the end, which is supposed to be enough for your survival in your retirement. This was one thing. The other thing was the provident funds, which was kind of long-term saving. They were less important. And the third thing were the DB pension employer sponsored funds, which belong to the trade union. Okay? And it should be noted that from the beginning, in Israel, the employers had no responsibility for what happened in the pension fund once they paid their contribution. Okay, this is very different from the U.S. case, where the DB pension fund itself belonged to in some way belonged to the corporation. So here it belonged to the Histadrut. The Histadrut, the trade union, was very powerful in the 50s when the pension funds were erected. But as time went on, the union became weaker and weaker. And they knew there was a problem with their pension funds because there were actuarial deficits. And the Treasury was, Finance Ministry were pushing for reform. And in 1990, giving you only really the headlights, in 1995, the old funds were closed to new participants, okay? So someone like myself still belongs to the old fund. And new participants, for new participants, there started completely new system of new pension funds. So we have the old pension funds or new pension funds or veteran pension funds, okay? Now, in 1995, they did not decide exactly what to do with the veteran pension funds. They waited for the opportunity, and the opportunity came in the year 2003. In 2001-2, there was a very substantial recession in Israel because of a combination of the world recession and the local intifada. And it was easy to convince the public that reform was needed for the pension fund, in spite of the fact that the pension fund is a long-term business. It has nothing to do with the crisis, etc., etc. But politics is politics. And what they did was to move first of all, to move the new pension funds into a total DC system, which I will explain in a moment. The explanation is very simple, but I will explain how it works. And the old pension funds, the DB, the one that I belong to, they were overtaken by a special manager, okay, who is nominated by the commissioner for insurance, etc. You know, this is standard. Like when the banks fail, you have a special manager, and here we have a special manager, and the special manager is managing it from there on, which is in some way, and if there are lawyers here, they should note, you're looking for subjects, the whole situation is not very kosher, because when you have a special manager, the role is to collect the assets, etc., and then do something with the assets. And here there is a special manager going on forever. There's no organs for the public. Kind of funny. I'm not sure what to do with this, because what they would probably want to do is to sell the old funds to the insurance companies, and I'm not sure this is such a good idea. So maybe the current situation is better. Okay, so now a very important clause at the new bylaws of the old pension funds was that having received government support of about 3.5 million shekels, which is about, billion shekels, which is about $1 billion per year for the next 35 years, which the money comes in regularly, by the way. Besides that, the government has no responsibility, and this is very important. If if people get older than expected, for example, then there should be a cut in the benefits. This is an important and unknown clause of this. So, in fact, it is actuarially self-balancing, and in some way it is also DC, in some way. So if the money is not enough, you cut the benefits. Okay. There is a... Okay, now you can read what's here. What I wanted to say about the private... Okay, now the new pension funds, which belonged first to the trade unions, because they were a corporation that was a daughter corporation of the old pension funds. When the appointed manager took hold of all the assets, one of the first things that they did was to sell the new pension funds, which was an asset of the funds, to sell them on the market to the insurance companies. They, as I said in my comments, they could have initiated NGOs to run it, they could have other kinds of arrangements, the government could manage it, but they sold it on the market because they wanted to have a prospering capital market. Okay? So the idea was to use the funds to foster the market, and I'm not inventing it. If you want, you can read what David Klein, the former governor of the Bank of Israel, before he was a governor and when he was governor, he said that the reform was needed because it was needed for the capital market. He didn't think about the savers. He thought about the capital market, because all over the world the pension funds are a source for the capital market. And as I said yesterday, the finance ministry has some kind of conflict of interest, because on the one hand they are taking care of the whole capital market, and they want to have the insurance companies should be sound, etc. And on the other hand, they have the authority to approve all the new bylaws of the pensions. Now, the bylaws of the pensions exclusively and in particular deal with the rights of the insured. So they are on both sides of the fence. They protect the insurees, and you know, in Israel, today being in a conflict of interest is a great deal, is really a big deal. Not only a real conflict of interest, even a hypothetical conflict of interest is not good. And the finance ministry is certainly at a serious conflict of interest. Okay. About the privatization, there was a general belief in Israel, especially in the markets, in the capital markets, and now that we know about the financial crisis and what led to the crisis, we know that it is not specific to Israel. Everybody believed in the capital markets. Alan Greenspan, who wrote in his autobiography that the markets are self-regulating, etc., etc. So everybody, it's not just in Israel, but we were trying to be in the fashion. Okay. So now I want to talk a little bit about the reversal, which is very interesting, the reversal. And so there are two instances of reversal. One instance is that the whole idea of mandatory pension is a reversal of the idea of free for all. The consumer knows what's best for him. If he wants to save, fine. If he doesn't want to save, he knows what's best for him. If we tell him what to do, we're paternalistic, and it's not a good idea. So, number one, this is one instance of paternalism. Now, the other instance, which fewer people know about, but it's very interesting, is the fact that no longer people are allowed to withdraw one lump sum when they retire from, for example, insurance companies. Insurance companies, the whole idea was that, wow, you get 2 million shekels when you retire, wow, you're rich. And what they do now is they force you to withdraw about $1,000 in an annuity before you can withdraw cash. Okay? So this is, if this is not paternalism, what is paternalism? Yes. And by the way, I support them 100%. I think it's very logical. I think that an annuity is a great idea, and it's a great kind of insurance, but we don't have time to. And another instance, which is very interesting, is that the Treasury, the Finance Ministry, believe that all they have to do is to give the market the information, and the participants will know what to do. And as a result, they published monthly returns in all pension funds, insurance funds, and provident funds. The result, as we know from all over the world, the result was short-term competition on yields, and we almost got here a financial crisis. I don't have time to go into that, but people who think, and yesterday I was talking to a lady from the Los Angeles Times, people who think that Israel went through the financial crisis unscathed. We almost had a financial crisis here. It was some kind of luck and other things which I don't have to go into, but the reason for that was this kind of short-term competition in the market, which the pension funds, insurance companies, provident funds were very important in it. Okay. Now, one thing that should be mentioned, again, is something that the pension reform of 2003 was the change in indexation. Change in indexation, people think that people who don't understand don't pay attention to, but the change in indexation is very important. All the payment basically many payments of the national insurance system here, Social Security, the first pillar, were indexed to the wage, to the average wage. And in the year 2003, as a part of the reform, it became indexed to the CPI. Since there is a trend of increase in wages, above 1% per year on average, sometimes 1.5% per year, it means the erosion of the relative position of what the first pillar is paying. Fortunately, because of political pressures, it did not happen that it was eroded. In fact, it was raised, but I'm not sure it's a good system here. Okay. Now, I brought you some numbers to show you how the assets of the pension arrangements were made. And you see, this is from 1997 on, which means from the time of the reform. And I'm sorry I don't have more updated data, but I was told that only economists worry so much about being updated, that sociologists are satisfied with seeing the trend, and the trend is very big. And you see the pension funds grow by 6% there, and okay, and you see that the life insurance part. Let me show you where the life insurance is. This is the life insurance part. you see that they are growing very fast as well. Okay, so that the part which is not pension funds, I told you, executive insurance it's called, they are growing. Let me see if I can show you. This is the insurance premiums. You can see very well. If you look at the assets, for example, executive insurance in 2007, you see that the total pension funds, which includes the veteran funds, okay, and the new funds, is a little more than the executive insurance. So the executive insurance are very present there in the market. It's not only the pension funds, it's also the executive insurance. Let me skip the premium and let me talk a little bit about the management fees. The management fees is a very important issue. It also used to be one of the things that nobody noticed. Who cares? Management fees, 0.5%, 2%. Sounds very small. But all the financial industry lives on the management fees. All those billions that we see around, all those yachts and $1 billion, I don't know, many $1 million salaries, all come from the management fees. So the management fees should be something important. Now, if you see the total assets here, if you see the total assets, then we are talking about 520 billion shekels, which is not surprising because the accumulation of each one of us prior to retirement should be more than 1 million shekels. Okay, so you and this is it's a big sum. You take a small percentage of it, and you have a very prospering industry. And this is exactly what happened after 1997. This financial industry came out of nothing, and at some point, in Israel we have people who have fantasies. So there was a fantasy. I cannot call it in another name. If it weren't a closed form, I would be less radical in my style. But there was a fantasy of creating in Israel a financial center that will probably compete, I don't know, maybe with London or New York. It's a total fantasy. Why would people bring their money here? But that was considered one of the ideas that the finance ministry tried to push. Luckily, there was the financial crisis, and it was abandoned. Okay. Now, what you see, the rate of management fees, and as you would expect, this is the new pension funds, and I'll be a little more with detail here. This is the actual management fees. The legal management fees are higher. There is some competition. And what you notice is that the insurance firms take 1.5% average on assets in 2005, but 2007, but there's no trend, as you see. And the new pension funds, it's 1/4 of what the executive pension are paying. Okay? So if you just look at management fees and premiums, the premiums it's almost the same, but the big thing is the assets. Okay? And what you see, by the way, is that executive insurance is inferior to pension fund 90% of the time. Okay? Still, I showed you a minute ago that it is prospering, and that shows you something about financial literacy. I'm not against financial literacy. I think that financial literacy is important, but I think it has its limits. I mean, everybody who knows something about pensions and looks at the management fees will say, well, I don't want to go to insurance, to executive insurance. I'm getting less. And you saw the growth. So, and why is that? Because of the marketing. The marketing by insurance agents. The insurance agents have more incentives to sell the executive insurance. And this is what you see. What to do about it? I don't know. I think this is capitalism. Okay. Now, you may say, okay, maybe the money was managed better under the insurance companies. And if you look at the average, okay, if you look at the average return on pension funds, where's the average? The average is a little higher, okay? The average is a little higher. But why is it a little higher? Because they take much more risk. You see, the standard deviation is 5.94, and the standard deviation here, okay, and the standard deviation here is 1.65. And why did they take more risk? Because they had an incentive. The way they were, the bonuses and everything depends on the return. Okay. So let me start to conclude by trying to evaluate the Israeli reform. And as Chu En-lai said, you know, his famous quote, you know Chu En-lai's quote? When they asked him about what do you think about the French Revolution and its effect on the world, he said it is too early to tell. So indeed it is too early to tell, but we see that investment returns were volatile and risky. We know that all the risk is now on the shoulder of the insured, okay, because it's a DC system, and we know that the crisis accentuated it, and the consumer lacks financial literacy, etc. But let me emphasize that this system is financially sound. And it is not something that we should take it lightly. Okay, it is very important. We should work within this system to improve it, but the financial soundness is very important. And this is probably one of the reasons that Israel went through the crisis well, because the foundations are good. If I sound from the Treasury, I'm not, but this is important. I have 2 more minutes to tell you about the further research that the project with Leah Achdut and myself. And what we are doing is we create real-life profiles of earnings from, and why is that important? Because in all the simulations, somehow there is an ideal saver, and the ideal saver is the one who works full-time all the time. And this is not what is happening. So we want to see how many years people really work. So we have the profiles. And as you can imagine, so these are profiles of some socioeconomic groups. These are, of course, the Jewish women which have academic degree, the Arab women less than 12 years, etc. And this is still the profile of the people who worked constantly. The other profiles are very preliminary, so I don't want to show them. We have the same profiles for the males, and you see that there's of course some error in the data, and I have very preliminary replacement ratios. I just show you that they are, but don't look at them because I think that there is some error in them. You know, with numbers. Numbers are very tricky. Until you get them right, it's difficult. I did some calculation for the replacement ratio, and I did it for, let's say, someone, so I did my own calculation. The replacement ratio for somebody who earns 10,000 shekels a year, and the wage is increasing by a month. But the wage is increasing by 1.2% per year, and kind of the return is not bad, is 4.25 real after inflation. Then my calculations show a replacement ratio of about 50%. Okay? If you add to that the Social Security, you get a 70% replacement ratio, which is not very bad. However, this is my own calculations. They're very preliminary. If we have another workshop next year, I'll have more result. Thank you very much.
Thank you. What do you mean if?